More Americans are defaulting on car loans than during the 2008 housing crash. Yeah, you heard that right. In 2026, people are losing their cars faster than homes were lost in the Great Recession. The average car payment is now $739 a month, but that's just the average. Tens of thousands are paying $1,200, $1,800, even $2,500 a month for trucks, SUVs, and sedans that lose value the second they leave the lot. And here's the kicker. Over 1 in 4 borrowers are underwater on their loans. That means they owe more than the car is worth, and they're still signing the dotted line. Why? Because they think debt equals status. But this isn't car ownership. It's financial slavery in leather seats. In this video, I'm breaking down the 10 most terrifying facts about how the car industry has turned everyday drivers into lifetime debt prisoners. If you've got a car note or you're thinking about getting one, you need to see this before you make your next payment. Number 10. They're not loans anymore. They're 7-year traps. These aren't car loans anymore. They're long-term, high-interest, asset-draining traps disguised as convenience. The average new car loan in the US is now a staggering 72 months. That's 6 years of locking yourself into payments for a car that's losing value every time you tap the brakes. And guess what? 1 in 5 new car loans is now 84 months, 7 full years. That means most Americans are literally committing to paying off a depreciating liability for almost an entire decade. And it gets worse. Interest rates have climbed to 7%, 9%, and even over 12% for people with less than perfect credit. So you walk into a dealership for a $32,000 SUV, and by the time that 7 years is up, you've shelled out over $48,000. That's $16,000 in interest, for a car that'll be worth maybe $10,000 by the time you own it. And no, you can't just refinance later if your credit doesn't improve or the rates don't come down. This isn't Monopoly, this is real life. What people don't realize is this. The longer the loan, the more front-loaded the interest, meaning you could spend 3 years making your $700 payments and barely touch the principal. Then life hits, you lose a job, get sick, your kid needs surgery, and suddenly you're underwater on a car that isn't worth half of what you owe. And now you can't even sell it to get out. That's not transportation, that's financial entrapment. It used to be that 5-year car loans were for luxury brands. Now it's the standard for mid-range sedans and base-model trucks. Dealers are stretching the terms not to help you afford the car. No, they're doing it. So the monthly payment looks just manageable enough to trap you. And people are falling for it. We've replaced common sense with, "Can I swing the monthly payment?" And the lenders are laughing all the way to the bank. The average American pays more for their car loan than their student loans or groceries, and yet we treat it like it's just part of life. It's not. It's engineered financial slavery. Wake up. Number 9. The real killer? Negative equity is the new normal. Nobody talks about this enough, but the most dangerous part of the car loan crisis? Negative equity. The terrifying reality is that 1 in 5 Americans trading in their vehicle today rolls an average of $5,500 in negative equity into their next loan. That means they owe more on their old car than it's worth, and instead of paying it off, the dealership just adds that debt onto the new loan. It's like putting a second mortgage on a house you already lost in a fire. And that's considered normal now. In fact, the latest data from Edmunds shows that 17.4% of people financing a new vehicle are now carrying $10,000 or more in negative equity. Let that sink in. You go to trade in your car, they say, "Sorry, it's only worth $15,000, but you still owe $25,000. They don't care. They smile, tell you, "We'll take care of it," and slap that $10,000 right on top of your new $40,000 loan. Now you're financing $50,000 for a car that costs $40,000 before interest. It's financial quicksand. And every month you make your $900 payment, that negative equity barely budges because most of it goes straight to interest. Now picture this. You total your car in year 2. Your insurance pays you what it's worth, maybe $28,000, but you still owe $45,000. You're on the hook for the difference. And now you have no car. That's why gap insurance exists, because the car loan system is so broken, they had to invent insurance to cover the debt you shouldn't have had in the first place. And here's the kicker. Most Americans don't even know they're underwater until it's too late. They think they've paid down their car because they've been paying religiously. Then they log into the portal and find out that after 18 months of payments, they've only shaved off $2,000 from the principal. That's when the panic sets in. Negative equity is debt inflation in real time, and it's turning car buyers into modern-day sharecroppers tied to their vehicle with no way out. Number 8. Monthly payments are replacing rent and no one noticed. Car payments have officially caught up to rent in America, and somehow we're just cool with that. According to Experience Q for 2025 data, the average new car payment is now $739 per month. But that's just the average. If your credit score is under 660, you're looking at $1,100, $1,400, even $2,000 plus, depending on the car and the loan term. And don't even think that's rare, it's not. There are now people driving 2023 Toyota Highlanders with $1,600 payments and others financing 6-year-old Ram trucks for $1,200 a month. In many American cities, that is literally more than a studio apartment. And it's not just the payment. Add insurance, which has skyrocketed due to vehicle repair inflation and theft risks, and suddenly you're paying $2,000 a month to own and operate a car. That's $24,000 a year for a single vehicle. And it's not even a luxury brand. That's your average SUV or truck. Meanwhile, wages haven't moved. Inflation-adjusted incomes are lower than they were 5 years ago, yet Americans are spending 15 to 20% of their take-home pay on cars. You're not just paying for wheels, you're paying for depreciation, interest, fees, insurance, and inflated maintenance schedules. And here's the worst part. We've normalized it. We've somehow accepted the idea that paying rent-level prices for a car is just the cost of adulting. The culture has completely shifted. It's no longer about whether you can afford a car, it's about whether you can juggle the payment for a few years before trading it in for even more debt. And it's generational. Boomers paid off their cars, millennials and Gen Z. They live inside their car note like it's a roommate they can't evict. It's robbing people of flexibility. You can't move, can't save, can't invest because your starter SUV has become your financial landlord. And no, this isn't a choice for most people. It's desperation wrapped in leather seats and financed through a 7-year plan you didn't understand when you signed it. This is not normal. This is not sustainable. This is a slow-motion car crash, and we're all still in the driver's seat. Number 7. The dealers know exactly what they're doing, and it's psychological warfare. This might shock you, but car dealerships don't care if you can afford the car, they care if they can convince you that you deserve it. Walk into any modern showroom and you're not entering a marketplace, you're stepping onto a psychological battlefield. These dealerships have studied behavioral finance like it's gospel. They don't need you to understand the math. They need you to feel like walking out without that shiny crossover means you're failing at life. Every inch of the dealership is designed to manipulate your emotions. The lighting, the coffee, the sales manager who's conveniently not available until after your 3rd test drive. And the financing? It's engineered confusion. The real price of the car disappears beneath a mountain of paperwork, bundled fees, and payment options. You ask, what's the total cost? And they answer, well, we can get your payment down to $795 if you stretch it to 84 months. They'll ask what you want your monthly to be, not what you want the car to cost. That's the hustle. And when they bring in the finance guy, he's not your advocate, he's the closer. He'll sell you on extended warranties, tire packages, theft insurance, ceramic coating all rolled into your loan. Don't want it? Cool, but your APR might go up without it. Yeah, they play games like that. You're emotional. You've test-driven the car. You've imagined yourself in it. They know you don't want to go home without it. And that's exactly when they drop the monthly bombshell and wait. You'll flinch. You'll hesitate. And then you'll say the words they live for. I guess I can make that work. That's not negotiation. That's surrender. And they prey hardest on the folks who've got the least experience and the weakest credit young buyers, single moms, newlyweds, struggling parents, first-timers who just need transportation. These aren't car sales, they're debt ambushes. And nobody walks out a winner but the dealership. It's time people realize these showrooms are just legalized traps, and the product isn't just the car, it's you. You're the product. Your paycheck is what they want. Your future is what they're mortgaging. And they're betting you'll keep coming back, because after all, they made the deal feel like your idea. Number 6. The repo man doesn't knock anymore, your car calls him. It used to be that missing a car payment meant a knock at the door or a tow truck in the middle of the night. Now, your car rats you out. We've entered the age of digital repossession, where vehicles equipped with smart tech can literally disable themselves, lock their own doors, or even drive away, all without human intervention. That's not a dystopian prediction. That's 2026 reality. Ford filed a patent for autonomous repossession technology last year, and it sent chills through the auto industry. The patent describes a system where, if a payment is missed, the vehicle sends warnings. If no response, the car disables functions, first the entertainment system, then air conditioning. Still not paying? It disables the engine, or worse, drives itself to the dealership or impound lot. Think about that. You could be at work, at the grocery store, in the middle of a school pickup, and your car decides it's done with you. This isn't just humiliating, it's dangerous. And it's not just new cars either. Most vehicles financed since 2020 are equipped with GPS tracking, immobilizers, and over-the-air control systems. Lenders don't need to hire a repo man anymore. They have the vehicle itself working as an enforcer, and they're using it. Auto repossessions surged by over 20% in 2025, according to Cox Automotive, as more borrowers defaulted under the weight of insane car payments. Subprime borrowers, those with the most predatory loans, are being targeted first. And here's the kicker. Many people get repoed while current on payments because of late fees or back-end technicalities buried in the fine print. You were a few days late, the system flagged it, and boom, you're on foot. No warning, no mercy. The lenders don't care about your situation. They're algorithm-driven now. And you know what the worst part is? These self-repo tech features are marketed as convenience upgrades. They sneak it into your sales contract like a benefit: remote diagnostics, enhanced vehicle communication, over-the-air updates. You don't know you just handed over control of your car to a finance company until they use it against you. And once it happens, good luck getting it back. You'll be hit with towing fees, repossession charges, reactivation costs, and all the late fees stacked on top. They don't want to help you, they want you to default. That's how they make their real money. And if you think that sounds insane, just wait. The AI-driven debt collection wave is just getting started. Number 5. Insurance is the silent killer that no one accounts for. Here's what nobody's telling you. It's not just the car payment that's killing Americans, it's the insurance premiums that come with it. You finally squeeze your budget tight enough to afford that $700 a month car note, and boom, GEICO hits you with a $290 bill. Add in registration, taxes, maintenance, and you're looking at another car payment just to keep the thing on the road. And it's not just bad luck or location, it's systemic. As of Q1 2026, the average full coverage premium is over $2,543 a year, with high-risk drivers in urban areas like Detroit or Miami seeing $5,000 plus annually. That's almost $420 a month for insurance. And if you finance, you have no choice. Lenders require full coverage. So your affordable Camry with a $550 payment turns into a $950 a month liability before you even put gas in it. And don't forget, the newer and pricier the car, the more expensive the insurance. Got a $50,000 SUV? You're not just paying for the car, you're paying for the cost to replace it. And if it's electric? Oh, buddy. EVs might save on fuel, but they send your premiums into orbit because repair costs are exponentially higher, especially for battery replacements or minor bodywork that requires tech recalibration. But the real kicker? Credit-based insurance pricing. That's right, your FICO score can impact your premium even more than your driving record. You could be a safe driver with no accidents, but if your credit score is 620, you'll pay hundreds more than a reckless driver with an 800 score. It's legal in 47 states. The insurance industry defends it as predictive behavior modeling. But let's call it what it is: class warfare with a glossy website. And heaven forbid you file a claim. You get rear-ended, it's not your fault, but now your rate jumps by 15% because the algorithm says you're statistically more likely to file again. There's no winning. It's like playing a rigged casino game, except instead of chips, you're gambling with your ability to get to work. The insurance burden is what pushes people out of their vehicles just as much as the car loan. And nobody calculates that when they walk into a dealership. By the time they figure it out, they're stuck. Can't sell the car, can't refinance, can't afford to switch carriers. This isn't just financial stress, it's vehicular entrapment by design. Number 4. Your car loan is killing your credit score, even if you're never late. Even if you never miss a single car payment, that shiny new loan might be quietly crushing your credit score. How? It's all about the debt-to-income and credit utilization ratios, the two numbers that lenders obsess over and that the average American doesn't even think about until it's too late. Let's break it down. You finance a $42,000 vehicle at 9% for 84 months. Your monthly payment's hovering around $720, and you're proud of never being late. But behind the scenes, lenders see a very different story. That loan shows up as a massive liability on your report, and the outstanding balance, which barely shrinks in the first 2 to 3 years due to front-loaded interest, makes your credit profile look like a financial house of cards. Worse, the loan size relative to your income tells banks that you're over-leveraged even if you've never defaulted. And if you try to get a mortgage, good luck. Mortgage lenders look at your total monthly debt obligations, and your car loan is eating up the space you need to qualify. You thought you were just buying a ride. Turns out you bought yourself a ticket out of the housing market, but it doesn't end there. That car note also locks up your ability to open new lines of credit, get favorable interest rates, or even secure a lease because creditors don't care how good your payment history is if your credit load is bloated. And here's something they never tell first-time buyers. Car loans don't help your credit the way people think. Sure, it's an installment loan, so it adds variety to your credit mix. But the second you take out a loan that's 100% of the vehicle value, your credit utilization spikes, and it stays high for years. You're better off with a used car and no loan at all. That builds credit faster. That gives you room to breathe. But most Americans walk into a dealership and walk out with a financial anchor around their necks, thinking they just leveled up. And meanwhile, their credit score is tanking while they're doing everything right. It's financial sabotage disguised as success, and it's working. Number 3. You're not driving a car, you're driving a depreciation bomb. Let's stop pretending these are assets. You are not building equity, you're not investing. You are literally strapping yourself into a rolling liability that loses value faster than almost anything else you'll ever buy. The moment you drive off the lot, your new car is worth 10 to 20% less on day one. Within the first year, most cars lose 30% of their value. By year 5, they've depreciated 50 to 60%. You think that $49,000 SUV is worth something because it still smells new? Go try to sell it. Dealers will offer you $28,000 if you're lucky. And this is where the trap tightens. Because if you're on a 72-month loan, guess what? You're still making full payments on a vehicle that's worth half of what you owe. That's not a car. That's a depreciation bomb, and you're sitting on it with no escape route. And don't even think it's just fancy cars. Even reliable brands like Honda, Toyota, and Ford aren't immune. In fact, with the average American switching cars every 3.5 years, most people never get close to owning their vehicle outright. They just roll the old loan into the new one, stacking negative equity on top of negative equity until they're upside down by $15,000 and don't even know it. This isn't a consumer choice. It's predatory design. The industry counts on it. The entire business model of auto lending is built around one fact. Cars lose value, but you don't stop paying. That's why they love long-term loans. That's why they push leasing. That's why the residual value is the most important number they never explain to you. And you're not just losing value on the car, you're losing opportunity. That $800 a month payment you're throwing at a depreciating SUV, that could have been an IRA, an index fund, or a down payment on a duplex. Instead, it's going toward a car that will be worth less than your iPhone in a few years. And let's not forget maintenance costs climb just as fast as value drops. So by year 4, your $55,000 investment has become a $19,000 ticking time bomb with worn brakes, a cracked windshield, and a repair bill that's not worth the hassle. And you still owe $28,000. The math doesn't lie. And once you run the numbers, you realize the scam. You were never buying a car. You were buying debt that looks like transportation. Number 2, this isn't just a payment. It's a lifestyle you can't escape. We need to stop calling them car payments. That phrase is too soft, too casual, like it's a Spotify subscription you can cancel if money gets tight. No. What we're talking about is a long-term financial lifestyle that reshapes how you live, what you eat, where you live, and whether or not you ever build wealth. For millions of Americans, that monthly $850 payment isn't just money out the door. It's the reason they can't move to a better neighborhood, the reason they keep working overtime, and the reason they don't sleep at night. It's not a transaction, it's a trap. According to the Federal Reserve's latest data, the average car payment now takes up 18 to 22% of Americans' after-tax income. And that doesn't include insurance, gas, or repairs. Add those in, and you're often looking at 35% of someone's entire paycheck being tied up in a vehicle. And that's before taxes. Think about what that does to a household. The money that could have gone into a Roth IRA, an emergency fund, a kid's dental work, or groceries? Gone. Month after month. For 6, 7, or even 8 years. And here's the killer: most Americans don't drive expensive cars because they want to be flashy. They do it because they've been psychologically conditioned to believe that a nice car equals success, that financing it is normal, that everyone has a car payment. This is debt culture, and it's so deep-rooted that people defend it. I've seen folks fight harder to keep their Escalade than their apartment. And don't get it twisted, the dealers, the lenders, and the automakers know this. They've weaponized FOMO, social pressure, and financial illiteracy into a machine that manufactures customers who never stop paying. And it's multi-generational now. Teens are getting co-signed into $45,000 loans at 18. People with a $40,000 income are driving $60,000 vehicles. And influencers are turning car debt into content, romanticizing the stress, showing off the aesthetic, while quietly begging TikTok to help pay down their principal. Y'all, this isn't just unsustainable. It's soul-breaking. It trains you to live paycheck to paycheck while pretending you're thriving. It punishes you for thinking short-term and chains you to a lifestyle you can't downsize out of. Once you sign, the lender owns your time, your money, your freedom, and there is no easy exit ramp. Number 1, they've made debt look like freedom, and we fell for it. The reason this entire car payment crisis has exploded isn't just bad math or poor financial planning, it's that they made debt feel like freedom. They sold us the idea that driving off the lot in something shiny, tech-loaded, and leather-wrapped was a milestone, a rite of passage, a sign you were finally doing okay. But in reality, you just signed up to give away 6 to 8 years of your financial future. It's not ownership, it's enslavement. And they marketed it like empowerment. You didn't buy a car. You bought a carefully engineered illusion. Because in this country, we've tied the idea of success to the appearance of wealth, not actual financial health. That's why you have nurses with $70,000 salaries driving $80,000 SUVs, bartenders leasing $65,000 BMWs, and teenagers in Hellcats they can't afford to gas up. And they all think they're winning because they qualified. But let me tell you, approval isn't an award, it's bait. The dealership isn't proud of you. The lender doesn't think you've made it. They're just smiling because they now own your income stream for the next 84 months. And here's the most sinister part. They've normalized this so deeply that people are shamed if they don't participate. You drive a 12-year-old Honda with a dent in the door? People look at you sideways. You drive a new Mercedes on a $1,500 note you can barely afford? Suddenly, you're respected. It's backwards. And social media has only made it worse. TikTok and Instagram have turned cars into content, making people think their value is tied to what they drive. You're not flexing anymore. You're bleeding and pretending it looks good. You're mortgaging your peace of mind for some momentary validation from people who don't even know your real name. And this isn't just an individual problem, it's national. Car debt in America now totals over $1.6 trillion, and the default rates are rising fast. As of 2026, auto loan delinquencies have hit the highest point since 2009. We're talking recession-era numbers, and still, people line up to sign the dotted line. Because they've been sold a lie that the car you drive determines your worth. And until we shatter that illusion, this crisis will keep growing. You can't build freedom on a foundation of debt. You can't drive your way out of a trap. And no, the answer is not a better interest rate, it's a better mindset. Walk away. Save. Buy used. Pay cash. Or better yet, stop buying the lie. If you've got a car payment, this wasn't just a video, it was your warning. Don't scroll past this like it's just content. This is your future we're talking about. So if you learned something today, hit like, drop a comment with your car payment, and subscribe because the system isn't slowing down, and neither are we. See you in the next one.